which is a pre-incubation training program for the budding startups organized by Entrepreneurship-Cell Amity University Rajasthan in association with Amity Innovation Incubator Jaipur, supported by Atal Innovation Mission and Institutions Innovation Council. The topic for today's session is Secretarial and Taxation, how to register a company and taxation for startups. And our expert for this session is CA Sambhav Mehrotra, who is the co-founder and senior consultant of Startup Movers Private Limited. You all can post your queries in the chat box or raise your hand to ask the same. Over to you, sir.
Thank you so much for the introduction. Before I begin, two things. I think I do not have the screen share access with me. So can you get that done, please?
Sure, sir. Can somebody please turn him into the presenter? Yes, sir. You're now the presenter. You can share your screen.
And second, last time also I was not able to see the queries in the chat box. I assume you will pick up in the end, right?
Sure, sir. Sure, sir.
Sure. I've shared my screen. Just confirm once if it's visible, and then I'll begin.
Yes, sir. It's perfectly visible.
Thank you. Good evening, all, and thank you, Amity, for giving another opportunity to be at ground zero. It's always very exciting to be amongst people who will always be at day zero, no matter how big your organization grows. Specifically in a startup ecosystem, day zero is very, very important. And we've already covered up one session on 21st of July. That was around finance, overall finance function, how you should shape a finance and its importance, and why finance should be an investment for an entrepreneur rather than just an expense. So topic for today, it is basically secretarial and taxation. Again, very big topics on their own, but we've just focused on a couple of topics, and we'll be focusing in detail on these two, which is how to register a company and then taxation for startups. And the presentation will run you through the following. The first slide, we missed it last time. That's a mistake at my end. Wherever I'm going in e-sales, that's the first slide I use. I just cover up for the mistake I did, that why do we need the startup ecosystem to grow in this country. Then we'll talk about the type of entities and the comparison between those. Then we'll basically move into why a private limited is required for a startup and how you can get a private limited company registered. From there on, we'll move into a bit of taxation around startups taxation and the kind of registrations that you will need to get benefits of certain provisions, where we'll talk about Startup India and angel tax registrations. We'll also talk about Section 80 IAC registration, which is the tax holiday, though it is not so easy to get and there are very, very few startups, but we'll touch upon it because maybe some of you might still be eligible to get this. And then if time permits, we'll just go into a bit of your questions and a bit of basics about how income tax will work for startups in a private limited structure. Okay, the first slide, as I said, I missed it last time. So India is entering into a stage of demographic dividend. So if my screen is visible to you clearly, what countries like Japan, China have gone through, we are just at the helm of it. I mean, we are just the beginning of that growth period. We have that kind of a dividend. Demographic dividend means the people who are there to work, right? For the next 37 years, we are in that golden period, right? Where our growth, our economy's growth can be directly proportional to the hands that we have on ground and the minds that can work. From 2018 till a period of 37 years, we'll be in this period of demographic dividend. And we have to sustain this. So it's not a goal of its own. It brings its own challenge that now Indian economy will need to continuously keep on creating new opportunities, new employment opportunities, and new entrepreneurship opportunities also, because this demographic dividend also calls for this opportunity to be there. Unless, apart from this, if we are not able to achieve these economic growth numbers, if there is high unemployment in the country, then it has its own adverse effects as well. But looking at the opportunity that India has for the next 30 or so years, startup ecosystem is very, very important for us. It is going to be a catalyst in terms of job creation. And it is also going to be a catalyst in giving the new dimensions and the new directions that our country needs for the next growth path, right? So just a description that is written, China entered it in 1994, and we've all seen the economic reforms that they have gone through. Of course, it's also a matter of the political stabilities and the functions that they follow. But it's a global phenomenon, right? You look at Japan and you look at other European countries. Those who've gone through this demographic dividend phase, we know the growth that they have had. It's our opportunity, it's our time, and I think as a part of that demographic dividend ecosystem, it's also our moral duty, and it's also our opportunity to make the most out of it for our country. Next slide, we'll basically talk about the kind of business entities that you can opt for. Now, these are the 4 typical things which you will hear from people around in the ecosystem. The first up is a proprietorship. What is a proprietorship? A proprietorship is nothing but something that you are doing on your own name. It has no distinct identity. So today, if I start a business in the name of ABC, that's my brand name, but I'm doing it in my own PAN card. I mean, I'm doing it in my own income tax credentials, right? It has no different entity or no different structure. Any business that you are doing in your individual capacity will be called as proprietorship. You will still need some sort of registrations like tax registrations in indirect taxes, say GST or payroll registration, but they all will be taken in your individual name. So as a business owner, you are fully responsible and liable for any losses or any frauds or any economic losses that the company that the business will face. And the drawback of this entity type is that it is having 100% liability. Even your personal assets can be attached. Hence, for small businesses, it is recommended. But when you have different stakeholders involved, you have different partners with you, you have other investors that you might want to bring on board, proprietorship is not the right model to go ahead with. We'll discuss it in the comparison in the next slide. Next up is a partnership firm. It can be registered, it can be unregistered. You can just get a stamp paper, get the standard terms defined on it, and you can have a partnership firm on day 0. It's easy to open as compared to other entity types, say LLP or company. Registration is not a must, but it is recommended because in the eyes of the law, if you are not registered, the court will follow standard protocols. So if you have, say, partnership terms in which your salaries are different and your profit sharing ratio is different, or business functions are clearly identified for partners, if you want that to be legitimate as per law, you need to get that registered with your registrar of firms. If you don't do it, you might still be counted as a partnership firm. But if you have a dispute that comes up, then in the court of law, you will face a challenge. So it's always recommended that a partnership firm, even if it is opened, it should be registered with a registrar of firms to give it a good legal standing, though it is not mandatory. And you will find a lot of businesses which are being run, specifically family-owned businesses or family and friend-owned businesses, where there's a partnership in place, but it is not registered. It is just created through a stamp paper agreement. You have a separate income tax registration and you are up. Again, this is a separate entity, but in this case also, there, as we said, that there is no transparency, and then there is liability also involved on the partners. It's not limited. So how do you basically go into structures which can give you more comfort, which can say, yeah, my personal assets will not be attached if something goes wrong, or if business goes bust, I don't have to basically worry about my personal assets are belonging until unless it's a fraud, right? So there comes 2 more options with you. One is a limited liability partnership, which is an enhanced or a better version of a partnership firm, but now it is registered with the registrar of companies, Ministry of Corporate Affairs, right? So this brings in transparency. And since this is an LLP, the word itself says limited liability. Your liability is restricted to the extent your partnership deed is giving reference to, right? So the only difference between a partnership firm and the limited liability partnership, I will come to that in the next slide when we will discuss the comparison in detail. And then finally, 4th option that you can see on the screen is a company. It can be a one-person company. OPCs are a recent phenomenon. 2-3 years back, they came up. 2013 Act brought them, to be honest. And they've not picked up in that quantum as they would have, because people still feel proprietorship would be a better and easy way for them to operate. OPC gives an option for them to still be a one-person company and still have a limited liability. But in India, this OPC system still has to pick up. People, when they want to work in individual capacity, they prefer proprietorship. Next is a private limited company. When there are two or more directors or two or more promoters that are getting together, you will open up a private limited company. You will need a minimum of 2 members to open up a private limited. If it's just one, you have to open a OPC. And after a private limited, you have option of public limited companies which can accept deposits or debt from public. We'll restrict our today's discussion to private limited companies. So for startup ecosystem, private limited companies are the most ideal structures to be formed because of reasons which we'll discuss in the next slide on comparisons, right? So we talked about 4 structures: partnership, LLP, OPC, and private limited. We are not discussing proprietorship on this slide, as we believe that's not a recommendation from our end if you guys are going into any kind of a business concern. What are the laws? All 4 are governed by different laws. Partnership gets covered under Partnership Act. LLP gets covered under LLP Act, which is under Corporate Affairs. And both OPC and private limited company will be covered under Companies Act. So why I am talking about law is that when you have to run these entities, you should be aware of the provisions of these acts. You cannot go and work outside provisions which are allowed as per these acts. What is the document that you create to get these entities in place? First up is a partnership agreement. When you are opening a partnership, as we said, it's a written agreement on a stamp paper. It can be registered or unregistered. However, when you go to LLP, it's some sort of a similar document. It's also a partnership agreement, but it has to be mandatorily registered and a stamp duty has to be paid to the government. For OPC and private limited companies, we prepare a document called Memorandum of Association and Article of Association, which are like Bibles and the rules in which the companies has to operate. These are pretty standard, except few things like objects, authorized capitals. So it gives a framework, and in that framework, you have options to modify. But whatever exists on this MOA and AOA, you cannot go beyond these terms. So for an example, if you are issuing some shares, now if your investors want preference shares, and if your AOA does not have the provision to issue a preference share, you will have to first amend your article of association, and then you can issue shares to the investor. So one problem that we've seen, and as a standard practice, what we offer to our portfolio clients is whenever they are raising funds, we look at their association, article of association and memorandum and see if it needs amendment for the fundraising to complete. Then number of members, partnership will have 2, LLP will have 2, OPC, of course, there's 1. As soon as you get another director or a promoter, you'll have to convert your OPC into a private limited company, where again, the number of members, which is the promoters or shareholders, is minimum 2. Minimum number of board members. In partnership, you can have 2 partners. LLP can have 2 partners, not less than that. In OPC, there can be 1 director, and in private limited, there has to be 2 directors for the entity to be operational. Then board meetings, it's a secretarial compliance. Partnership, no such requirement. That is why it is simple to operate. LLP, again, there is no requirement of a board meeting as such. However, to take certain decisions, you might have to create resolutions. For example, if you have to open a bank account, if you have to get your tax registrations, even in LLP, people will ask for resolutions in which you can do a meeting and then pass it. But LLP Act doesn't require you to hold board meetings for X number of times in a year, whereas that is mandatory in OPC and private limited company. Similarly, for a shareholders meeting, in partnership, you don't have shareholders, you just have partners. Same for LLP, so there is no requirement of a shareholders meeting. Even in OPC, there is just one shareholder who holds 100% shareholding, who's the owner. Hence, in this case, also a specific shareholder meeting is not needed. But as soon as you go to a private limited company, your secretarial compliances will go up, and there has to be one shareholding meeting, which is called the AGM, which is mandatory. Apart from it, there are decisions that you cannot take without taking consent of the shareholders, for which you call extraordinary general meetings. So you will be seeing from this slide that there are more secretarial compliances in private limited as compared to other models. Moving on, if you are trying to raise funds for your company or your idea, partnership is not the way to go, because you will have to bring that investor as a partner, and he'll not be willing to be a say a working partner, and the exits through partnerships are not so easy. Similarly, in LLP model you can get, but there are certain approvals that needs to be taken. Again, not a preferred route. OPC cannot have external investments because then it becomes a externally held company, and the whole purpose of OPC dilutes. So it's just a private limited company, which we recommend as the go-to model if you want to raise funds for your startup later on. Foreign investment not allowed in partnerships. LLPs can have it, but they will need approval. Not allowed in OPC, as we discussed. It's a one-person company. In private limited, yes, you can raise funds from abroad, both through an automatic route and an approval route. What's an automatic and approval route? There are few sectors where you can directly get the money from investors. You just have to inform the government. For an example, IT sector. So if you have a SaaS product that you're developing, and if you're getting money from abroad as investment, you just have to inform the government that through RBI that we've got this money at arm's length price. However, if you have startups in defense sector or real estate sector, which are prohibited, then you have to take permission from government first. And when they approve, then you can get money into India. Then any half yearly compliances, partnership has nothing at all. LLP has nothing at all. OPCs just have MSME disclosures. So does private limited. It is where basically you have to inform the government that are you holding any payments of an MSME beyond 45 days? Because MSME Act says that you cannot have an outstanding of greater than 45 days for an MSME without valid reasons. So government asks you why you are holding a payment beyond 45 days and what is the reason. And then the annual compliance in partnership, you just have to file an ITR, income tax return. There are no separate returns to be filed to registrar of firms or anything unless you change the partnership. So if you're amending your partnership deed, then you only have to go back to registrar of firms. Otherwise, there is no other requirement in partnership. In LLP, you file income tax return, but there are two compliances which are mandatory every year, where you file your financials with the ROC and you tell them that had there been any change in the partnership profit sharing ratio or any fresh contribution has been given by any partner during the year. So these are the two returns that go in LLP. So typically 3 annual compliances. Apart from it, if there is any change in LLP, a new partner has been added, there is a retirement, change in terms, getting additional capital. In all those cases, those are assignment-based compliances to be done, which are one-off. Then comes OPC. In OPC also, similar story. You have to do the income tax return. You have to do the financials filing at the end of the year. You also need to inform whether OPC got sold to anybody else. So OPC can be sold and there can be one more person buying it. In that case, the annual return will give the ownership change if at all there is any change. Then there are additional 2 requirements. These are not this is not an exhaustive list. This is recommendatory list, and there are more compliances for both OPCs and private limited, where then KYC is you have to inform every year to the government that the director's particulars in terms of address, phone number, emails, they have not changed and he can be basically identified. So you basically inform the government about any changes that have happened. And then there is a DPT3 form, which is recent development, where private limited companies cannot accept deposits from anybody. So it can raise funds through equity. It can raise funds through its shareholders and directors, but private limited company cannot take money from anybody else as a debt, except banks and few institutions, NBFCs. So to regularize this, government has basically informed companies to file a DPT form and tell ROCs if there are any debts in the company which needs to be regularized, or tell the ROC that we are fully compliant and there is no debt in the company. Moving on, so we've discussed about types of entities and we've done some comparison. We've basically figured out that private limited is the go-to model if we are going in a startup ecosystem and we want to do fundraise. Also, private limited are the most transparent of the structures, where any filings that you are doing can be seen on the ROC portal by paying 100 rupees. All the financials can be taken out, all the fundraising can be seen. So it's a transparent model and hence most acceptable. It's also a flexible model where changing the directors, changing the shareholders, getting additional capital, all those are pretty flexible things to be done, and all of those are online. So in that sense, private limited is again our go-to model. And specifically in startup ecosystem, the challenge that which comes up with private limited company is the closure. So in this ecosystem, there are more failures as a historical data point and statistics than success. And the problem is when you open a private limited company and your ideas do not go through, then you have to close a private limited company. Otherwise, there are penalties or non-compliance fees that keeps on piling up. And as a founder, say initial 6-8 months, you decide not to continue and you leave the private limited like that, you are going to face some material penalties. So as a founder, be very careful that in a private limited, opening might be an easy task. Running it might also be an easy task, but it's important that it's also closed. It's not bad to fail, it's good to learn. So if you are learning and if you are moving on to some next idea or you've decided not to continue with it, please ensure that you are doing a formal closure of the entity also, so that there is no add-on compliance cost or penalties that comes on the directors. Coming on to how you can register a private limited company, what are the basics that are required? So as we discussed, you will need at least 2 shareholders, and which are called members or promoters, and 2 directors to begin with. These 4 people, the KYC will need to be done. So there will be basic set of documents that will be required: PAN card, identification proof, photographs. There are certain documentations to be given in terms of declarations. So we need to have these 4. So the 2 promoters can be the 2 directors, or there can be 2 different identities also. So as promoter, you don't want to get into operations. So you are bringing, say, professionals on board to run the company, but they are not the shareholders. So there are cases where the promoters and the directors are different. So all these individuals, ID and address proof are needed. The KYC of all the promoters and directors is mandatory. Next, you will need what is called as digital signature certificate, because the whole process is now online. There is no manual intervention, and the process to sign and to basically authenticate your forms and all documentation, you use a USB pen drive kind of a equipment, which has a software which encrypts your document. That's called a digital signature certificate. It's individual. Every individual has a unique TSC. Typically, your service provider will get this made for you. Good practice is to have it in your own custody. But as a practical standpoint, you will see that most of the consultants and the service provider will have these DSCs on your behalf, so that the compliances can easily be managed. However, you should follow a protocol of the usage where even if the custody of these DSCs are with your consultants, in no manner they should be used without your consent or approval. So if any form has been used, you should get into an agreement with your consultants, if you are leaving your DSCs with them, that any use of DSC should prior be authorized by you over email or in written, and then they should be used. So DSCs are something that are made pervasively to move ahead with the process. And in order to make DSCs, you need to have the KYCs of the promoters done. Then the most critical step, what should be the name of the private limited entity? So ROC has a naming guideline. All provisions are there. It cannot be identical. It should not resemble to a IP or a trademark. There are words which are restricted, so like you cannot use India. There are ways and means of using India in your name. So for an example, if you're using India as your first word, then your authorized capital, I could be wrong, should be 50 lakhs. If India is coming in between, so ABC India Private Limited, then it has to be minimum 5 lakhs. So those are the criterias for selection of name. And the problem is we now have such a big database that more or less whenever you look out for a name, there are certain bottlenecks or objections that are bound to come from the department. So you can go and check out the name availability on the ROC website. It's mca.gov.in. However, it's not foolproof. So it might say that nobody has that name, but when you apply it, there would be objections that come out from the registrar's office, which will say it resembles or it has trademark obligations, or there could be blah, blah, any number of reasons. So that's one challenge historically we have seen, where it took 3 months at one point of time just around this naming thing, early on about 8-9 years back. And now it's a very speed up process. There has been a lot of developments around ease of doing business. It has iterated 4 or 5 times the way you apply to the ROC for getting the private limited registered. The first step is you apply for a name. You can go ahead and do everything in one go. But what we recommend is first apply the name, get the name reserved, and then you do your for the documentation, because if your name gets rejected, then all your documentation that you would have done will also be impacted. So the right approach here is apply the name, get the reservation, and then move ahead with other filings. Though government is giving you an option where in one go you can choose the name and do all the documentations together. But the problem, as I said, we face there is if there is an objection to the name, then all your documentations will have to be done again. So get your name registered first, talk to your consultants, look out for the naming guidelines, and ensure that your name resembles to the work that you are doing and the brand that you will follow. So your name cannot be like ABC Shipping Company and it is into airlines, right? So if it's in airline business, use names which are oriented towards that sector. So it cannot be like ABC Trading Company and you are giving medical services, right? So your name has to resemble to what you are doing. Next up, along with the name, is the business object, which is very, very important, right? Your main object will define the activity that the company is doing. And this is where your consultant will come back to you and asks about which activity you are planning to do. Now, what happens in startup ecosystem most of the times is what we begin with, we might not end up being in that model for a very long time. We might pivot and change it. So it's important that if we have selected a business object early on as our main object and later we pivoted to something else, then we need to get our memorandum changed and ensure that our main object resembles to the activity that we are doing. So when you are registering your company along with the name, another thing that you will be asked to describe is the activity that you plan to do, and then a consultant will give back you a legal language or how that has to be drafted in your memorandum, right? So these are mandatory to get your company up and running. You can or cannot get your registered office during the incorporation. You can defer it also, but there are few challenges that are coming up in registered office space. Challenge number one, we don't have a space of our own. How should I get a registered office? Challenge number two, we don't even have resources to take space on rent. How can we get a registered office of our own? Challenge number three, even if we find somebody, friends or family, or a person who's ready to help us, his documentation at times is incomplete. In that case, the form gets rejected. So registered office is a space which needs a special attention because the documentation has to be complete for the offices to be recognized. So take an example of e-cell, right? Maybe there are companies that are being incubated in this e-cell. Amity might as well be giving you the space to register on Amity Innovation Incubator Jaipur address. I don't know, you might have faced this challenge already, but in terms of documentation that is being asked by the registered office space, they might not basically agree to the documentation that e-cells provide. And hence the documentation around registered office space is something that has, if you see, become a business model of its own, where co-working locations have started giving out these spaces, or business centers have created this as a product, where if you do not have a space, you do not have a commercial space or an identifiable space, you can go out to these co-working companies and service providers who are giving you these services as a product, and they will give you all the right documentation to get your registration done. So when you are creating a private limited, registered office is one thing which you have to be careful about, because all your communications from ROC, apart from the E mode, will happen physically on your registered office address, and there could be an inspection also later on. So it's important that the address that you use has your identification and a nameplate written over that space, so that whenever there's an inspection, it should not be like it's a bogus space. In that case, you might face notices from ROC that it's a bogus company and they might strike you off, and then you have to face problems. So you should be very, very careful about registered office space also. Prima facie, these are the 6 things that you need to have as a requirement to go to your consultant. And step by step, as I said, first the name will be approved. Once your name is approved, then other forms will be filed, which is memorandum, article, who are the directors, who are the shareholders, and then registered office along with it. When all the documents are intact and in order, registrar of companies will issue you a document called certificate of incorporation. So what we've done the first step, the DSC procurement. We've done the name reservation, which is the step 2. It says typically 24 hours. Yes, it is like that. We are looking at responses coming within 24 hours. When the name is approved, we prepare the documents. And once your forms are filed, the ROC will issue you a document called Certificate of Incorporation, which is an identification that now a separate legal entity exists and which is different from its promoters and directors. So that's the crux, or that's the USP of a private limited company, that a new business has taken birth, right? Once the certificate of incorporation is issued to you, that's not the end step, right? Just don't stop there. Next step is you will need to open a bank account and transfer the authorized, the paid up capital that you would have declared. Now that needs to be done within 60 days of the certificate of incorporation. And another form called certificate of commencement is filed. I think government has recently done away with it. Pardon me for the update. This deck might not be updated, but there is a requirement historically which talks about certificate of commencement to be filed, which is evidence of that now capital has been put in by the director or the shareholders and everything is good to go. Typically speaking, this is where the process will end and you will have a private limited with you duly registered, where you can start the work. But there are two more compliances that you will definitely need to do within the first 30 days. One is you will need to do RBI compliance if your paid up capital is, say, coming from a foreign fund. So you basically have tied up with some foreign entity who's a promoter now with you. If the money is coming from abroad, you will also need to do RBI compliances. However, if you are just Indian shareholders and directors, then RBI compliance is not needed. Another thing that you will need to do is appointment of an auditor, the first auditor. That needs to be done within 30 days. The way around and why this doesn't become a challenge of the records is that you are not mandatorily required to report it to the ROC. So even if you are delayed, at most of the times you might not be able to do this in 30 days. In that case, when you go back to a consultant, there are ways and means to do this. However, as a good business and governance practice, have your auditors appointed in the first 30 days. Another thing I would like to focus on the requirement here is, in case you have foreign directors or foreign shareholders, right? There is a requirement of what is called as apostillation. So in India, you have notarization, that there would be documents which your consultant will ask to get notarized from a notary, which is easy. You go to a lawyer, he just puts stamps. In India, it's very easy process, right? But when it comes to foreign directors or foreign shareholders, you will need to basically do a thing called as apostillation, which is again notarization. But the process there is expensive and time consuming because it is done through embassies, right? So when you are having a foreign director or a promoter in your framework, make sure that you are aware of these apostillation requirements and factor in the time that will be required. Because you might want to start off in 10-15 days, but the apostillation might take itself 20-25 days. So just take a note of it if you have a foreign director and a shareholder in your framework. Okay, moving on. Basically, under the Startup India plan, 2016 is when it started. Just hold on. Okay, so from private limited, now we have a business that is up and running. Our bank account is up. We would have got the other registrations done also that we discussed the last time around. Now there is another registration that you need to do to be recognized as a startup in India, which is called Startup India Recognition, which is effective from 2016 as a Startup India Action Plan. And if you meet the definition as prescribed in the notification, you can apply for recognition in this program. Typically, all companies that are getting registered will fall in this. So it's become a kind of a default registrations that are being given. But the caveat here is there is a cancellation provision retrospectively in the act. So even if you've got the recognition and you're not complying with these guidelines, government will come back and retrospectively cancel a registration, and whatever penal actions might come in lieu of that, they could be a business continuation risk itself. So how you can register for Startup India? You have to be a private limited company or a registered partnership firm, as we discussed. If it's registered, you are allowed to register in Startup India, or a limited liability partnership. The turnover should not be more than 100 crores, right? It should not, it has to be incorporated after 1st April 16. And then the entity shall be considered a startup up to 10 years from the date of its incorporation. The startup should be working towards innovation, improvement of products, services, processes, and should have potential to generate employment and create wealth. An entity formed by splitting up or reconstruction of an existing business shall not be considered a startup. Now, what will happen in the current scenario is, uh, because your early stage companies, in any case, you are not going to be defaulting in any of these terms. So you can apply for Startup India recognition. Most likely, if all data is correct, they ask for your business plan, they ask for certain declarations. The number is given to you, which is given by DPIIT, and it's called the Startup India registration number. Now, for them to recognize early on whether this is a reconstruction of an existing business. So there was already a manufacturing company and they thought, yeah, chalo Startup India ka benefit lenge. It was running from 2004. They started a new company, right, with same shareholders and same directors. So at the initial stage, the authorities might not be aware and they might give it. But later on, if they figure out that this was just a reconstruction, they have powers through the notification to cancel it retrospectively, right? So this recognition has to be used in the right spirit. What benefits it gives you? You can go on startupindia.gov.in. There is plethora of literature on it, where it tells about a specific promotion in tenders where startups are given a specific reference. You have special reservations there. Easy payroll, easy HR compliances, labor law compliances are not that stringent the first 3 years. In terms of getting grants and in terms of raising funds, you might be required to be a Startup India registered company. And then there are other sorts of benefits also, which you can just go to the website and have a look at them. Next is typically in this ecosystem, the one problem because of which the Startup India registration became redundant was that despite of being a startup, income tax was coming pretty hard on these companies who were raising funds. What was the problem like? Problem was, I will say, yeah, I raised money at 100 rupees. I raised money at 100 rupees and income tax officer say, no, this is not a correct valuation. Your valuation is 50 rupees, you raise 50 extra, or your valuation was exorbitant. The remaining 50 I am putting in your tax bracket. And the companies were given notices for 25% of the value of this addition plus the penalties. And now look at the ecosystem which was trying to create jobs and which was bringing FDI in the country. All of a sudden, there were so many assessment cases in startup ecosystem where income tax came very hard on these companies. When this 2016 Startup India program started, for about till 17-18, we faced this issue. And then there was a representation by the ecosystem where government came out with another registration to be done along with Startup India, which is tax exemption under Section 56 of Income Tax Act, known as angel tax in this ecosystem. This is called angel tax exemption. What it says that angel tax is the tax charged on the closely held company. Closely held means private limited company. So this is not talking about limited companies, because limited companies in any case raise money through the SEBI platform, which is very, very strict on its own. When it issues shares to a resident person, this section is not applicable to a non-resident at a price which is more than its fair market value. When this provision is triggered, the aggregate consideration received from issue of shares as exceeds, as I said, you said 100, officer said 50, he adds 50 to your income. So 50 becomes your income from other sources under section 56.2.7b, which is now 56.2.10c. Post getting recognition as a startup, you can apply to bypass this law, bypass this provision, where if you have this certificate or this angel tax exemption, your assessment or assessing officer will not go into depth of your valuations. They will give you an exemptions. What are the terms? You should be recognized as a startup. First step, get yourself registered as a Startup India under DPIIT. Second step, apply for this angel tax exemption. It will ask you for your identification number, and it will ask you for a declaration that your aggregate amount of paid up share capital and share premium of the startup after the issue of shares will not cross 25 crores. So up to 25 crores is what it is limited to. After that, this angel tax will not hold good and the provisions will still be applicable. So now the ecosystem is pushing for that. The terms needs to be changed. And then if this limit can be increased, because with this maturity of the ecosystem, many companies will raise this amount. So the idea is that this relaxation should be enhanced or exceeded to cover up further rounds. But even with this 25 crores limit that came in, a lot of assessment cases dropped in day zero itself, and there was a lot of relief to the ecosystem. So it's recommended that you take both the registrations post your company is incorporated. Then next is your tax exemption under section 80 IAC. So we are not going into depth of the taxation of a startup. It's a private limited company. Tax laws are same, right? You are paying tax as a business income. Same tax rates apply to you, 25% if you are into normal business. If you are coming into manufacturing space, it's 17%. So you can go back to your consultants and talk about specific sector-based tax rates. However, there are broadly two that we discussed. But there is a option for you to claim tax exemption for 3 years. The percentage of these exemptions granted is running in single-digit percentage. It is approved through interministerial board, so it's not an easy recognition to take. This has become more of a default. The Startup India and the DPIIT. If you apply, you get it in 2 days. But this is very strict. You apply, it will take 4 to 5, 6 months. There could be hearings. You will have to produce your case, and you have to convince them that yes, what is the disruption that you are doing? You are not a orthodox business which already exists in market. Yes, you are going to create a lot of jobs out there. So all that validation happens, and hence the tax exemption is not being given to a lot of companies. My personal view is it's also got to do with the integrity and the honesty that the authorities have to the citizens and citizens have to the authority, that it's still not a trust game. So before giving out this tax exemption, government is not trusting you, and you are not trusting government because we feel that this is a benefit to be taken, so we'll not get it in one go. So that culture issue is what I feel personally is also there. Of course, there is that huge filter because of which the numbers are very, very low. But I think it's also a function of, I mean, the large number of denials are also an example of maybe the government is also not trusting the ecosystem, and there is also a function of a huge revenue loss or a revenue allocation that might be required for this section. But we'll still study this, because even if 1 or 2 of you are able to get this benefit, that's great. So what does section 80 IAC talk about? It says that if you are an eligible startup, so this does not give you eligibility, this is recognition. Eligibility comes from interministerial board. If you are an eligible startup and you are making profits, the problem is startup do not make profits in early days. So why is it talking about profits? Profits and gains derived from eligible business. So if your business later on changes, you did not inform them, right? And it's an illegal business, or it's not the business for which your recognition was given to you, you will not be allowed this exemption. In accordance with and subject to provision of this section, this is a legal language, just forget about it. In computing the total income of the SSE, which is the startup, a deduction. So it's talking about a deduction. So if I have 5 crores of profit, it says 5 crores will be deducted. A deduction of an amount equal to 100% of the profits and gains derived from business. So you are tax free. You will pay no tax to the government irrespective of the profits you have, but you already have a limit of 100 crores. So you can figure out if you have margins, how margins are there in your business. So there is a threshold limit on even the profits, but it is allowed for a period of 3 consecutive financial years out of first 10 years in incorporation. So you have to declare to the government that now we are going to start taking this exemption. But if in next 2 years you have loss, then this law is very ambiguous. It doesn't say you can carry forward. It says it was not our business, you didn't make profits, done, right? But it has to be 3 consecutive periods. And hence, because of the ambiguities of this section itself, and because startup ecosystems do not make so much of profits, they are growth oriented product development startups which are thinking long term. The efficiency of this exemption is not that freely available to genuine startup ecosystem companies, and those who are trying to work around in normal business and trying to claim this exemption, they are in any case not getting through the filter. So that's why you see a very, very small number of companies who've got this tax exemption under section 80 IAC. Whether you should apply, yes, you should, but the success ratio is very, very less. So what's the eligibility criteria? Only private limited company or partnership firm, as we discussed, who are registered under DPIIT, they should be incorporated after 1st April 16. Turnover should not cross 100 crores. Your angel tax exemption should have been filed. And like the point 5, which is the biggest filter point, right? Working towards innovation, development or improvement or products or process or service, or if it is a scalable business model with a high potential of employment generation. Now, there is a question that comes up. It says the word or, and in any business model, I can generate 10,000 of jobs. Then why should I not get it? Valid question, something that we are also evaluating of why more number of companies are not being given this ATISE. But to be honest, we do not have a practical exposures where we've just applied for the applications which got rejected. We do not have a success pie yet that we can share with you. And hence, there could be some consultants which can throw more light on it. But according to us, the definition says that all companies fall into that criteria. You should definitely apply for it. But given the success ratio, don't be very, very reliable. Don't get relied on this that I'll raise funds because I'll get a three-year tax holiday and becomes a USP. Don't think in that direction. Who cannot opt? As we discussed initially, you cannot opt by splitting up or reconstruction. Today, Reliance can open another company and qualify it as a startup. So Geo was a typical startup kind of a domain and a mindset. Imagine they are applying for ATISE and government giving them this registration, right? I mean, crores of taxation loss just due to reconstruction, not allowed. An entity who have opted section 115BAA while filing the last year ITR form. So what has happened is there is this provision called MAT, which is called minimum alternate tax. So if initial years you have losses in your startup and now you start making money in say in 5th year, you have an option to offset your losses with your profits later on in future years. But there is this concept of called minimum alternate tax, that if you have profits on your books, even if you have brought forward losses, they ask for certain percentage of profits to be paid as tax, which is allowed as a credit in future. This MAT has become a problem because in some cases, this became a cash flow issue for companies and startups where they said, yeah, we just started making money. We have so much of losses of previous years. Unnecessarily, we are paying a cash to the government, which is just lying with them and we are not utilizing it. It's not actually a tax. It's just a set off for future years. So there is this section which talks about certain deductions that you will not be claiming and the rate of your taxation comes down. In this section, one of the deduction that you have to forego is ATISE, right? So if you are foregoing this ATISE deduction, your tax rate will further come down. So to 2 or 3% is the criteria. Pardon me for that exact figure. We can deliver that to you if needed. But where section 115BAA is coming a viable option in our last 1 or 2 years is where one, there is clear-cut visibility that ATISE is not going to be there. So we recommend people to opt for this section so that they are not at least getting saved from paying MAT and they have a lower tax rate comparatively also. Or if the company is now shutting down and it has certain liabilities to be set off, so there are cases where there could be a income on the books, but there are brought forward losses. So we are telling people to forego ATISE and opt for 115BAA so that they don't end up paying MAT. It's a tax planning. If any one of you is in that kind of a situation, we can discuss in detail one-on-one. So 115BAA and your ATISE, the tax exemption for startup, they are kind of a tax planning that needs to be evaluated. However, we've not seen any ATISE yet. If someone of you comes out from ECL Jaipur, Amity Innovation Incubator, will be more than happy to take learnings from you. An entity who has not recognized a startup by DPIIT, so it goes in a staggered manner. Step 1, get yourself registered under Startup India. Step 2, get yourself registered for angel tax exemption. Step 3, if you want, you can go for ATISE. If you do not want, that's okay. It's not a mandatory thing that you need to have a 3-year tax holiday. You can basically go ahead and continue your business with normal Startup India registration. That also has a lot of its benefits. Okay, so that's where I will want to basically stop today and take questions. I have another back-to-back session at 6:30. Sorry, I was not aware. So I've cut down on a couple of slides, which typically talked about MAT and income tax in details and the GST. But those are very elaborative topics, and figuring that out in 10-15 minutes in any case would not have made a lot of sense. So what I will want to focus on is questions that you all have around these two things, which is getting your private limited registered and ATIAC and the taxation for startups. Yeah.
Thank you, sir. Participants, you can share your questions in the chat box or you can raise hand to ask them. Sir, there is a question in the chat box. Being a startup, when is the right time to register as a company?
Great question. I think I should have covered it in the comparison. So if you are basically not aware of your proof of concept, right? You have an idea, but the POC is still pending. Your MVP is also not there, a minimum viable product. And you're just testing it out. I mean, you just want to look at some research areas. You might as well not want to open a private limited at that time. You might want to do it in a proprietorship kind of stuff because you don't need registrations and all. You just start doing the research work. However, if you already have an MVP or a proof of concept that is established, and you have multiple people, say 2 or 3 founders working on it, it's advisable that if you're looking at a long-term picture, get a private limited done, because one, it gives that picture to the other stakeholders outside that there is seriousness and they're not just trying their hands out. Two, if things start falling in the right direction, you don't waste a lot of time in getting structures in place. So typically, I will say, look at your proof of concept. If it's established, you already have a product, or you already have a framework to make that product. You have more than 1 founders on board. Go ahead and get your private limited registration done.
Sir, I believe there are no more queries, so can we conclude the session?
Yes. Yes, please. From mine, it's all good.
Okay, so we have one more question from the participants. What is the difference between Company Regiment Act and I don't know, but it's REG Act and Society REG Act?
Okay, companies is so there are typically 2 structures, in fact 3 structures when you go out in the startup ecosystem. One is for profit. I am working in a sector where I want to make shareholders value, which we discussed on 21st. And for that, you will register a private limited company, which will fall under the Companies Act, which is what you are referring to as Company Registration Act. I do not want to go into a for-profit model. I have a model which is on sustainability, and I'll raise CSR fund and grants. In that case, I will not open a private limited. I will open a society or a trust or a Section 8 company, which is also governed by Ministry of Corporate Affairs, which is not for profit. I mean, the whole idea is to prohibit from you making any profits. That's around sustainability. So I have an idea. So I have done some research and I brought out technology for waste management. And I do not want to make money out of it. I just want sustainability. And hence, there is a society that I registered, which is under Society Registration Act, which is the Societies Act. Now there is a third model, which is a hybrid, where I built a technology for waste management. I'll provide it as a service from a for-profit, but in order to promote this usage, I will have a NGO or a non-profit which will do the brand building or awareness for the product that I have. So in that case, you need both, where you register a private limited, it for profit, or you tie up with an NGO for awareness, or you open your own NGO to create a hybrid structure. So societies are typically covered under Societies Act. Companies are covered under Companies Act. For profit, not for profit.
Thank you, sir. The participant has asked one another question. Can we do business under Society Registration Act?
Yes, you can, but it's a very complicated model because typically societies are created for a common cause. They work on a principle of what we call as mutuality, right? So you and I are a part of say an RWA, right? So the mutuality there is we have to collect money to run our society. Similarly, there are societies with common objectives. They can do business. The members are then given a profit sharing ratio of how the contribution has come in. But typically, societies are not the right way to do businesses. They are called association of persons. They are created for specified. So if you're doing one specific thing and then after that it will close down, say in 3 or 4 months or 5 months, and you do not want to create a business model for it, you can create a association of person. You don't need even a society for it. But opening up a society to do business, those are very typical business of chit fund or fundraise is what I am aware of. Genuine service line business or trading business or manufacturing concerns, I have not seen in a society so far. Not the right way to do business.
Thank you, sir. There is another question. Sir, you talked about consultants. So who are these consultants? Are they chartered accountants or the mentors from the incubator? And how can the participants contact them?
Yeah, I did not share that slide with you guys. So please allow me to share that again once more. So who are these consultants? So the Startup Movers is one of those. Are they chartered accountants? Yes and no. I mean, it's not typically that this function will be done only by chartered accountants. This can be done by company secretaries. These can also be done by service providers. So there are online portals like Vakil Search, and now every day you will see some or the other person sending out you emailer, advertise emailers for this, where they'll say we'll register a private limited company for you. But typically, such consultants should be your long-term partners. I mean, find somebody who you can rely on as a consultant in terms of, अच्छा company जो बन गया इसके बाद how framework will set up in terms of other things. So you are not going to other different service providers for each individual task. You find places where all of your things can be done in one place. So how is an incubator supporting you? Because you're able to solve all your questions. So this specifically this whole program that you are going through, you're getting everything on one platform. Similarly, it's for finance and legal side. It's okay to have subject matter experts. So you can have a lawyer, you can have a CS, you can have a CA, but it's also required that you have somebody as a single point of contact. So like this company Startup Movers that I'm an advisor for, it's basically a conglomerate of different professionals and service providers. But for you, it's one POC of that company who's solving it for you. Like I said, consultant here are people from financial ecosystem. They can be chartered accountants. They can be company secretaries. CA and CS are mandatory because they need to sign your form. The incorporation form that you will fill up or will you file with the ROC, you will also sign with your digital signatures that we talked about, and a CA also has to sign it, or a CS. So yes, a CA and CS is mandatorily required to open up a private limited company.
So another question is, do consultancy services or business need to be registered at a certain point if income is more?
Just a second. Can you repeat the question, please?
Sure, sir. Do consultancy services or businesses need to be registered at a certain point if income is more?
I don't think the private limited registration has got anything to do with the income part. Even if you're developing a product, you have zero income for the next 2 years, you should still have your private limited because that's where your IP or the product will be built. So it's not a function of income which will define whether you should open a private limited or not. It is the overall vision that will define whether you want to open a private limited or not. So you cannot say that I have a product. Now, when I have a lakh rupees of income, then I will open a company, and otherwise I'll continue with my proprietorship. This is subjective. You have to take a conscious call on the long-term vision, your partners involved, and it has got nothing to do with the income that you have. Yes, your GST registrations will have threshold limits of 20 lakhs and 40 lakhs, but your private limited has got no such limits of incorporating. There is no mandate which says, oh, only after 5 lakh you can open up a private limited company.
Thank you, sir. Sir, since there are no more questions, shall we conclude the session?
Yes, please. Thank you for having me. It was indeed a mutual learning.
Thank you so much, sir, for sharing your knowledge. It was great to have you here with us. I would now like to thank on behalf of Team Entrepreneurship-Cell, Amity University Rajasthan and Amity Innovation Incubator Jaipur to our honorable guest CA Sambhav Mehrotra for joining us today and enlightening young entrepreneurs with his experience. I would also like to thank Dr. Manju Kaushik, organizing chair, for her kind support throughout the event. A very special mention for the entire IT team and a hearty thanks to the entire team of Entrepreneurship-Cell AUR for their tireless efforts and dedication in organizing such knowledgeable events, and to the wonderful audience present here today. Thank you all for joining today's session. I guess we can end the meeting right now. Sir, can we end the meeting for all?